The way most people approach investing is completely wrong. They chase trends, follow the crowd, react to market movements, and hope to make quick profits. But over time, this approach leads to mistakes, losses, and frustration. In The Intelligent Investor by Benjamin Graham, you learn a completely different way to think about investing, one built on discipline, patience, and long-term value. In this audiobook, I'll break down the book chapter by chapter, simplifying its key ideas so you can understand how to approach investing the right way. By the end of this video, you'll understand how to think like an intelligent investor and avoid the common mistakes that hold most people back. Chapter 1. Investment versus Speculation. Benjamin Graham begins the book by defining one of the most important ideas in investing: the difference between investing and speculating. According to him, an investment is an operation that is based on thorough analysis, protects your capital, and offers a reasonable return. Anything that does not meet these conditions is considered speculation. This sounds simple, but this is where most people get it wrong. Many people believe they are investing when they are actually speculating. They buy stocks because they are trending, because everyone is talking about them, or because they expect quick profits. For example, imagine buying a stock just because it's going viral online, or because someone said it will blow. That decision is not based on analysis. It's driven by hype and expectation. That is speculation. Graham makes it clear that there is nothing wrong with speculation, as long as you are aware of it and you control your risk. The real danger is when people speculate but think they are investing. Another key idea in this chapter is that the market is unpredictable in the short term. Prices move based on news, emotions, and crowd behavior, not always on real value. That is why Graham emphasizes something very important. The intelligent investor focuses on value, not price. A true investor does not panic when prices fall, does not get carried away when prices rise, and does not chase quick gains. Instead, they stay disciplined and think long-term. Graham also highlights that behavior matters more than intelligence in investing. You can have knowledge, but still fail if you panic during downturns, get greedy when the market is rising, or follow the crowd without thinking. In the end, the biggest enemy of the investor is often not the market, but themselves. To sum it up, in Chapter 1, Benjamin Graham explains that investing is not the same as speculation. True investing requires discipline, analysis, and long-term thinking, while speculation is driven by emotion and short-term movements. The key lesson is simple. Don't just invest your money. Understand what you're doing and why you're doing it. Chapter 2. The Investor and Inflation. In this chapter, Benjamin Graham explains how inflation affects your money over time and why every investor must take it seriously. His main point is simple. Inflation reduces your purchasing power. This means that even if your money stays the same in numbers, it becomes less valuable over time because prices increase. For example, something you can buy today for $10,000 might cost $15,000 or more in the future. If your money is not growing, you are actually losing value without realizing it. This is why Graham emphasizes that saving alone is not enough. You must invest to grow your money. However, he also warns against reacting emotionally to inflation. When people hear about rising inflation, they often panic. They rush into investments, chase trends, or make decisions based on fear, thinking they are protecting their money. But Graham makes it clear. Reacting out of fear often leads to worse decisions than inflation itself. He explains how different investments respond to inflation. Stocks can perform well over time because businesses can grow and adjust prices. Bonds provide stability, but may lose value in real terms when inflation rises. This leads to an important idea. No single investment is perfect. That is why Graham supports diversification, spreading your money across different types of investments to reduce risk. Another key lesson is that inflation is unpredictable. No one can accurately forecast how it will behave in the short term. So instead of trying to guess, investors should build a long-term strategy that can handle different economic conditions. The deeper message here is that staying calm and disciplined is more important than trying to outsmart inflation. To sum it up, in Chapter 2, Benjamin Graham teaches that inflation quietly reduces the value of money. So investors must focus on growing their wealth, not just saving it. The key lesson is simple. Don't ignore inflation, but don't let fear of it control your decisions. Chapter 3. A Century of Stock Market History. In this chapter, Benjamin Graham uses history to teach one powerful lesson. The stock market moves in cycles. Over time, the market goes through periods of growth, decline, optimism, and fear. These cycles repeat again and again. Graham shows that during periods of strong growth, many investors become overly confident. They believe prices will keep rising, so they rush in, invest heavily, and sometimes take unnecessary risks. For example, when the market is booming, people often say things like, "This time is different." "Prices will keep going up." "You can't lose in this market." But history shows that these moments are often followed by sharp declines. On the other hand, when the market is falling, fear takes over. Prices drop, people panic, and many investors sell their investments at a loss. Ironically, these are often the best times to invest. This leads to one of the most important ideas in this chapter. The market is driven more by human emotions than logic. Greed pushes prices too high. Fear pushes prices too low. Because of this, Graham warns investors not to follow the crowd blindly. Another key lesson is that short-term market movements are unreliable, but long-term trends are more meaningful. Even though the market goes through ups and downs, it has historically grown over long periods. That is why Graham encourages investors to focus on the long term instead of reacting to daily changes. He also emphasizes that history is one of the best teachers in investing. By studying past market behavior, investors can better understand how bubbles form, how crashes happen, and how emotions affect decisions. The deeper message is simple. Market conditions may change, but human behavior stays the same. To sum it up, in Chapter 3, Benjamin Graham teaches that the stock market moves in cycles driven by greed and fear. Periods of excitement often lead to overvaluation, while periods of fear can create opportunities. The key lesson is simple. Don't follow the crowd. Understand the cycle and think long-term. Chapter 4. General Portfolio Policy, the Defensive Investor. In this chapter, Benjamin Graham introduces the idea that not all investors are the same. He divides investors into two main types: the defensive, passive investor, the enterprising, active investor. This chapter focuses on the defensive investor, someone who wants to invest safely, simply, and with minimal effort. The defensive investor is not trying to beat the market or chase high returns. Instead, their goal is to protect their capital, avoid serious mistakes, and achieve steady, reasonable growth over time. Graham makes it clear that this approach is not weak, it is smart and disciplined. Many people believe they need to constantly monitor the market, pick the best stocks, and make frequent decisions to succeed. But Graham argues that this often leads to more mistakes, not better results. For example, Someone who is always buying and selling based on news or emotions may feel active, but they are also increasing their risk of making poor decisions. In contrast, the defensive investor keeps things simple. Graham recommends a balanced portfolio of stocks for growth and bonds for stability. He suggests that a defensive investor should never put all their money into one type of investment. Instead, they should maintain a mix, typically somewhere between 25% to 75% in stocks, and the rest in bonds. This balance helps protect against extreme losses while still allowing for growth. This introduces a very important principle. The goal is not to maximize returns. It is to manage risk. Another key idea in this chapter is that consistency beats activity. A defensive investor does not chase trends, react to every market movement, or try to time the market. Instead, they stick to a plan and make adjustments only when necessary. For example, if stocks grow too much and take up a larger portion of the portfolio, the investor may rebalance by selling some stocks and buying bonds. This keeps the portfolio stable and aligned with their strategy. Graham also emphasizes that simplicity is an advantage. You don't need complex strategies or constant decision-making to succeed. In fact, trying to do too much often leads to confusion, stress, and poor results. The deeper message of this chapter is that a well-structured, disciplined approach is more powerful than constant action. To sum it up, in Chapter 4, Benjamin Graham teaches that the defensive investor focuses on safety, simplicity, and long-term stability. By maintaining a balanced portfolio of stocks and bonds and avoiding unnecessary activity, they reduce risk and improve their chances of steady success. The key lesson is simple. You don't need to do more to succeed in investing. You need to do the right things consistently. Chapter 5. The Defensive Investor and Common Stocks. In this chapter, Benjamin Graham explains how a defensive investor should approach investing in stocks. His main point is simple. Not all stocks are suitable for a defensive investor. Because the defensive investor's goal is safety and stability, they must be selective about the type of stocks they buy. Graham recommends focusing on high-quality, established companies, not risky or speculative ones. These are companies that have a strong financial position, have been operating for many years, have a consistent record of earnings, and pay regular dividends. For example, instead of chasing a new, fast-rising company with uncertain future profits, a defensive investor would choose a stable company with a long track record, even if its growth is slower. This introduces a very important principle. Stability is more important than excitement. Many investors are attracted to stocks that are hot or rapidly increasing in price. But Graham warns that these types of stocks often come with higher risk and uncertainty. Another key idea in this chapter is diversification within stocks. Graham advises that a defensive investor should not rely on just one or two stocks. Instead, they should spread their investments across multiple companies. For example, instead of putting all your money into one company, you might invest in 10 to 30 different well-established companies. This reduces the impact if one of them performs poorly. This leads to another important lesson. You don't need to pick the perfect stock. You need to avoid the wrong ones. Graham also introduces the idea of valuation. Even a good company can be a bad investment if you pay too much for it. That is why the defensive investor should avoid stocks that are overpriced, driven by hype, or trading far above their actual value. The focus should always be on buying quality at a reasonable price. For example, if a company is doing well but its stock price is extremely high compared to its earnings, it may not be a wise investment. The deeper message of this chapter is that discipline and selectivity protect you from unnecessary risk. To sum it up, in Chapter 5, Benjamin Graham teaches that the defensive investor should focus on strong, stable companies, diversify their investments, and avoid overpaying for stocks. The key lesson is simple. Choose quality over hype and always pay attention to value, not just price movement. Chapter 6. Portfolio Policy for the Enterprising Investor. Negative Approach. In this chapter, Benjamin Graham shifts focus to the enterprising, active investor, someone willing to put in more time, effort, and research to potentially achieve better results. But instead of starting with what the enterprising investor should do, Graham first explains what they should avoid. This is why he calls it the negative approach. His main point is simple. Success in investing often comes from avoiding mistakes before trying to achieve gains. Graham warns that many investors fail, not because they lack opportunities, but because they fall into common traps. He highlights several types of investments the enterprising investor should be cautious about. 1. Overhyped or popular stocks. These are stocks that are widely talked about and heavily promoted. For example, when everyone is excited about a particular company and its price is rising quickly, many investors rush in, expecting easy profits. But Graham warns, when something is popular, it is often already overpriced. 2. New issues, IPOs. These are stocks being offered to the public for the first time. While they may seem exciting, Graham points out that new issues are often priced in a way that benefits the sellers, not the buyers. In simple terms, you are often paying a premium for something unproven. 3. Low quality or speculative stocks. These include companies with weak financials, inconsistent earnings, or uncertain futures. They may look cheap, but they are risky. Graham emphasizes that cheap does not always mean good value. 4. Complex or unclear investments. If an investment is too complicated to understand, it becomes dangerous. Graham strongly believes, if you don't understand it, you shouldn't invest in it. The overall idea of this chapter is about discipline and self-control. The enterprising investor may have more freedom than the defensive investor, but that also means more responsibility. Without clear boundaries, it becomes easy to chase trends, follow the crowd, or take unnecessary risks. Graham is teaching that before you try to win, you must first learn how to avoid losing. To sum it up, in Chapter 6, Benjamin Graham teaches that the enterprising investor should focus on avoiding common investment mistakes, such as chasing popular stocks, buying overpriced new issues, and investing in low-quality companies. The key lesson is simple. Protecting yourself from bad decisions is the foundation of successful investing. Chapter 7. Portfolio Policy for the Enterprising Investor. The Positive Side. In this chapter, Benjamin Graham explains what the enterprising investor should actually do to achieve better results. Unlike the defensive investor, who focuses on simplicity and safety, the enterprising investor is willing to put in more time, do deeper research, and make more active decisions. But this extra effort must be done carefully and intelligently. Graham's main point is simple. Higher returns are possible, but only if you have discipline, knowledge, and patience. He outlines several strategies the enterprising investor can use. 1. Buying undervalued stocks. This is one of the core ideas in the book. The enterprising investor looks for stocks that are priced below their true value. These are companies that may be temporarily ignored, misunderstood, or undervalued by the market. For example, a strong company might experience a short-term problem, causing its stock price to drop. While others panic and sell The intelligent investor sees an opportunity. This introduces a powerful idea. The best opportunities often appear when others are losing confidence. 2. Taking advantage of market mistakes. The market does not always price stocks correctly. Sometimes it becomes too optimistic and sometimes too pessimistic. The enterprising investor takes advantage of these mistakes instead of reacting emotionally to them. This requires patience. Instead of chasing rising prices, the investor waits for moments when prices are unreasonably low. 3. Careful selection and analysis. Unlike the defensive investor, the enterprising investor must do detailed analysis. They study financial statements, company performance, earnings history, and overall stability. This is not about guessing. It is about making informed decisions. Graham makes it clear, if you are not willing to do the work, you should not follow this approach. 4. Special situations. These are unique opportunities such as company reorganizations, mergers, or temporary market inefficiencies. These situations can offer profit opportunities, but they require experience and careful judgment. Another key lesson in this chapter is that being active does not mean being careless. Many people think active investing means constant buying and selling, but Graham emphasizes that true enterprising investing is selective, patient, and disciplined. The goal is not to make more moves, it is to make better moves. The deeper message of this chapter is that effort alone does not guarantee success. Intelligent effort does. To sum it up, in Chapter 7, Benjamin Graham teaches that the enterprising investor can achieve higher returns by finding undervalued stocks, taking advantage of market mistakes, and doing careful analysis. The key lesson is simple. If you want better results, you must be willing to do deeper work, and do it with discipline. Chapter 8. The Investor and Market Fluctuations. Mr. Market. In this chapter, Benjamin Graham introduces one of his most famous concepts, Mr. Market. Mr. Market is not a real person. He is a symbol used to describe how the stock market behaves. Graham asks you to imagine that you own a business, and you have a partner named Mr. Market. Every day, Mr. Market comes to you and offers to either buy your share or sell you his share. But here's the problem. Mr. Market is extremely emotional. Some days, he is very optimistic. He believes everything is going well, so he offers to buy your shares at a very high price. Other days, he is pessimistic. He becomes fearful and offers to sell his shares at a very low price. The key thing to understand is this. Mr. Market's mood changes constantly, but the value of the business does not change that quickly. Graham's main message is simple. The market is there to serve you, not to guide you. Most people do the opposite. They look at market prices and assume they must act. When prices go up, they buy. When prices go down, they sell. This is exactly what Mr. Market's emotions push people to do. But Graham warns, if you follow the market's mood, you will make emotional decisions, and emotional decisions lead to poor results. A disciplined investor treats Mr. Market differently. They do not react to every price change. Instead, they use Mr. Market's behavior to their advantage. For example, when Mr. Market is fearful and prices are low, it may be a good time to buy. When Mr. Market is overly optimistic and prices are high, it may be a good time to be cautious. In simple terms, you don't follow the market, you take advantage of it. Imagine a strong company whose stock price drops suddenly because of bad news or general market panic. Most people see the falling price and assume something is wrong, so they sell. But a disciplined investor asks a different question. Has the actual value of the company changed, or is this just market emotion? If the value is still strong, the lower price becomes an opportunity. Graham makes something very clear. The biggest risk is not market fluctuation, it is your reaction to it. Many investors lose money not because the market moves, but because they panic during downturns, get greedy during uptrends, and constantly react instead of thinking. Mr. Market is not your advisor. He is your opportunity provider. Some days, he offers you a bad deal. Ignore him. Other days, he offers you a great deal. Take advantage of it. To sum it up, in Chapter 8, Benjamin Graham teaches that the market behaves like an emotional partner who constantly offers prices based on mood, not value. The key lesson is simple. Don't follow the market's emotions. Use them to your advantage. Chapter 9. Investing in Investment Funds. In this chapter, Benjamin Graham explains how investors can use investment funds as a way to participate in the stock market without having to pick individual stocks. Investment funds, also known as mutual funds, pool money from many investors and are managed by professionals who decide how to invest that money. Graham's main point is simple. Investment funds can be a good option, but they are not automatically safe or superior. He divides funds into two main types: defensive, conservative funds, aggressive, growth-focused funds. Defensive funds aim for stability and steady returns, while aggressive funds try to achieve higher growth, often by taking on more risk. For a defensive investor, funds can be useful because they provide diversification, professional management, and simplicity. For example, instead of trying to analyze and select 20 different stocks, an investor can invest in a fund that already holds a diversified portfolio. This reduces the risk of relying on one or two investments. However, Graham also warns that not all funds perform well. Many investors assume that professional managers will consistently beat the market, but in reality, this is not always the case. In fact, many funds fail to outperform the market after fees and expenses are considered. This introduces an important idea. Higher effort, or professional management, does not guarantee better results. Another key point is that investors should pay attention to management quality, fees and expenses, and long-term performance. High fees can reduce returns over time, even if the fund performs reasonably well. Graham also warns against chasing funds that have recently performed well. For example, if a fund has delivered high returns in the past year, many investors rush to invest in it, expecting the performance to continue. But Graham makes it clear, past performance does not guarantee future results. The deeper message of this chapter is that investment funds are tools, not shortcuts. They can help simplify investing and reduce risk, but they still require careful selection and realistic expectations. To sum it up, in Chapter 9, Benjamin Graham teaches that investment funds can provide diversification and professional management, making them a useful option for many investors. The key lesson is simple. Don't assume a fund is a good investment. Understand how it works, what it costs, and what you can realistically expect from it. Chapter 10. The Investor and His Advisors. In this chapter, Benjamin Graham discusses the role of financial advisors and whether investors should rely on them. His main point is simple. Advice can be helpful, but it is not a substitute for understanding what you are doing. Graham explains that there are different types of advisors: brokers, investment counselors, and financial institutions. Some advisors are focused on helping you make sound decisions, while others may be more interested in generating commissions through frequent buying and selling. This creates an important distinction. Not all advice is given in your best interest. For example, a broker who earns money from transactions may encourage more activity, even when it is not necessary. This can lead to overtrading, higher costs, and poorer results. Graham warns that blindly following advice without understanding it can be dangerous. This leads to a key principle. You should never invest in something you do not understand, even if someone recommends it. Another important idea in this chapter is that good advice is usually simple, consistent, and aligned with long-term goals. If an advisor is constantly changing strategies, making bold predictions, or encouraging risky behavior, it is a sign to be cautious. Graham also emphasizes that investors should take responsibility for their own decisions. Even if you choose to work with an advisor, you should. Ask questions, understand the reasoning behind recommendations, and stay involved in your investments. The goal is not to depend completely on others, but to make informed decisions. For example, instead of blindly following a recommendation to buy a stock, a smart investor would ask, "Why is this a good investment? What are the risks? How does it fit into my overall strategy?" The deeper message of this chapter is that trust should be combined with understanding. Advice can guide you, but it should never replace your own judgment. To sum it up, in Chapter 10, Benjamin Graham teaches that while financial advisors can provide useful guidance, investors must remain informed and responsible for their own decisions. The key lesson is simple. Don't rely on advice blindly. Understand it, question it, and make your own informed choices. Chapter 11. Security Analysis for the Lay Investor. General Approach. In this chapter, Benjamin Graham introduces the basic principles of analyzing stocks in a way that everyday investors can understand. His main point is simple. You don't need to be an expert to analyze investments, but you do need a clear and disciplined approach. Graham explains that before investing in any company, you should look beyond the stock price and focus on the business itself. This includes understanding what the company does, how it makes money, and how consistent its performance has been. For example, instead of buying a stock just because the price is going up, a smart investor would ask, "Is this company profitable? Has it been stable over time? Does it have a strong financial position?" This shifts the focus from price to value. Another key idea in this chapter is the importance of earnings. Earnings represent the company's ability to generate profit. Graham emphasizes that investors should pay attention to consistent earnings over time, not just short-term spikes. A company that performs well consistently is generally more reliable than one with unpredictable results. Graham also introduces the idea of looking at a company's financial strength. This includes factors like manageable debt, strong assets, and overall stability. For example, a company with too much debt may struggle during difficult economic periods, making it a riskier investment. Another important lesson is that investors should avoid making decisions based on rumors, market trends, or short-term excitement. Instead, decisions should be based on facts and analysis. Graham makes it clear, the goal is not to predict the future. It is to make intelligent decisions based on available information. He also encourages investors to stay realistic. You don't need perfect information or perfect timing. What matters is having a reasonable level of understanding and making decisions that are grounded in logic rather than emotion. The deeper message of this chapter is that investing should be based on understanding businesses, not reacting to price movements. To sum it up, in Chapter 11, Benjamin Graham teaches that even everyday investors can analyze stocks by focusing on a company's earnings, financial strength, and overall stability. The key lesson is simple. Don't invest based on price movement or hype. Invest based on understanding the business behind the stock. Chapter 12. Things to consider about earnings. Per share, EPS. In this chapter, Benjamin Graham explains why investors should be careful when interpreting earnings per share, EPS, and not take the numbers at face value. His main point is simple. Earnings per share is important, but it can be misleading if you don't understand what's behind it. EPS represents a company's profit, divided by the number of its shares. Many investors use it to judge how well a company is performing, but Graham warns that companies can present their earnings in ways that make performance look stronger than it actually is. For example, a company might report high earnings in a particular year because of one-time gains, asset sales, or unusual events. These do not reflect the company's true, ongoing performance. This leads to an important idea. Not all earnings are equal. Graham encourages investors to focus on average earnings over several years, rather than relying on a single year's result. For example, instead of being impressed by one strong year, a smart investor would look at the company's performance over the past 5 to 10 years. This helps reveal whether the business is truly stable and consistent. Another key point is that companies can sometimes adjust or present earnings using different accounting methods. This doesn't always mean something is wrong, but it means the numbers may not tell the full story. That is why investors should look deeper and understand what is actually driving those earnings. Graham also emphasizes the importance of comparing earnings to the price of the stock. A company may have strong earnings, but if its stock price is too high relative to those earnings, it may not be a good investment. This reinforces a core principle. A good company is not always a good investment. Price matters. Another important lesson is to be cautious of companies with inconsistent earnings, sudden spikes in performance, or irregular financial records. These can be signs of instability or increased risk. The deeper message of this chapter is that intelligent investing requires critical thinking, not blind trust in reported numbers. To sum it up, in Chapter 12, Benjamin Graham teaches that earnings per share, EPS, is a useful tool, but it must be analyzed carefully. The key lesson is simple. Don't rely on one-year earnings, focus on long-term consistency, and always understand the story behind the numbers. Chapter 13. A comparison of 4 listed companies. In this chapter, Benjamin Graham takes a practical approach by comparing 4 real companies to show how investors should analyze stocks. His main point is simple. Looking at numbers alone is not enough. You must understand what those numbers actually mean. Graham presents 4 companies that, at first glance, may seem similar. But when you examine them more closely, you begin to see clear differences in financial strength, earnings consistency, growth patterns, and overall stability. This comparison highlights an important lesson. 2 companies can look attractive on the surface, but be very different in reality. For example, one company may show strong recent growth, which attracts attention, but when you look deeper, you might find unstable earnings, high debt, or inconsistent performance. Another company may appear less exciting but has steady earnings, strong financial health, and long-term stability. Graham shows that the second company is often the better investment, even if it is not the most popular. This leads to a powerful idea. Excitement does not equal value. Many investors are drawn to companies with rapid growth or strong recent performance. But Graham warns that this can be misleading if it is not supported by solid fundamentals. Another key lesson in this chapter is the importance of comparing multiple companies instead of analyzing just one in isolation. When you compare companies side by side, it becomes easier to spot strengths and weaknesses, identify risks, and make better decisions. For example, a company's earnings might seem strong on its own, but when compared to another company in the same industry, it may actually be underperforming. Graham also emphasizes that investors should not rely on popularity, market opinion, or recent trends. Instead, decisions should be based on facts, consistency, and long-term performance. The deeper message of this chapter is that intelligent investing requires careful comparison and independent thinking. To sum it up, in Chapter 13, Benjamin Graham teaches that comparing companies helps investors see beyond surface-level performance and make better decisions. The key lesson is simple. Don't judge a company in isolation. Compare, analyze, and focus on long-term strength over short-term excitement. Chapter 14. Stock Selection for the Defensive Investor. In this chapter, Benjamin Graham explains how the defensive investor should actually select stocks, building on the principles introduced earlier. His main point is simple. The defensive investor should follow clear, strict criteria to reduce risk and avoid mistakes. Instead of trying to find the best or most exciting stocks, the defensive investor focuses on reliable, proven companies that meet specific standards. Graham outlines several key guidelines. 1. Adequate size of the company. The company should be large and well-established. Bigger companies are generally more stable and less likely to collapse during difficult times. Smaller companies may offer higher growth, but they also come with higher risk. 2. Strong financial condition. The company should have a solid financial position, including manageable debt, sufficient assets, and the ability to meet its obligations. For example, a company that is heavily in debt may struggle during economic downturns, making it a riskier investment. 3. Earnings stability. The company should have a consistent record of earnings over many years. Graham suggests looking for companies that have shown steady performance rather than unpredictable results. This reinforces an important idea. Consistency is more valuable than occasional success. 4. Dividend record. The company should have a history of paying dividends. Dividends show that a company is profitable and willing to return value to its shareholders. A long record of dividend payments also indicates stability. 5. Moderate growth. The company should show reasonable growth over time, not extreme or unrealistic increases. Rapid growth can be attractive, but it often comes with higher uncertainty. 6. Reasonable price. Even a strong company can be a poor investment if the price is too high. Graham emphasizes that investors should avoid overpaying by looking at price relative to earnings and overall valuation. This reinforces one of the most important principles in the book. Price matters just as much as quality. Imagine choosing between two companies. One is trending, growing fast, and everyone is talking about it. The other is stable, consistent, and less exciting. Most people will choose the first. But Graham's approach leads you to choose the second, because it is safer, more predictable, and more reliable over time. The defensive investor wins not by making bold moves, but by avoiding major mistakes. By following strict rules, they reduce the chance of overpaying, choosing weak companies, or reacting emotionally. To sum it up, in Chapter 14, Benjamin Graham teaches that the defensive investor should follow strict selection criteria, focusing on strong, stable companies and avoiding overpaying. The key lesson is simple. Choose safety and consistency over excitement, and always stick to disciplined rules when selecting stocks. Chapter 15. Stock Selection for the Enterprising Investor. In this chapter, Benjamin Graham explains how the enterprising investor selects stocks, building on the more active approach discussed earlier. His main point is simple. The enterprising investor looks for opportunities where the market has made a mistake. Unlike the defensive investor, who focuses on safety and simplicity, the enterprising investor is willing to go deeper, analyzing companies more carefully to find undervalued opportunities. Graham outlines several strategies the enterprising investor can use. 1. Buying bargain issues, undervalued stocks. This is one of the most important strategies. The enterprising investor looks for stocks that are selling below their true value. These companies may be overlooked, temporarily out of favor, or misunderstood by the market. For example, a solid company might face short-term problems, causing its stock price to drop. While others panic and sell, the enterprising investor sees a potential opportunity. This reinforces a powerful idea. The best investments are often found where others are not looking. 2. Secondary companies. These are companies that are not industry leaders but are still financially sound and undervalued. They may not be popular or widely followed, which is exactly why they can offer good opportunities. 3. Unpopular or neglected stocks. Some companies are ignored simply because they are not trending or exciting. Graham points out that this lack of attention can create opportunities for investors who are willing to do the research. This leads to an important principle. Popularity often increases price, but not necessarily value. 4. Special situations. These include events like mergers, reorganizations, or temporary disruptions. These situations can create pricing inefficiencies that an enterprising investor can take advantage of. However, Graham warns that these require careful analysis and experience. Graham makes it clear that this approach is not for everyone. The enterprising investor must be willing to spend time analyzing companies, remain patient, and stay disciplined. Without these qualities, it becomes easy to make poor decisions, misjudge value, or take unnecessary risks. Imagine a company that is performing well overall, but its stock price drops due to negative news or short-term fear. Most investors avoid it, but the enterprising investor asks, is the business actually weak, or is the market overreacting? If the fundamentals are still strong, this could be a buying opportunity. The enterprising investor does not follow the crowd. They think independently, look for value where others don't, and take advantage of market inefficiencies. But success depends on discipline, patience, and effort, not just activity. To sum it up, in Chapter 15, Benjamin Graham teaches that the enterprising investor seeks undervalued stocks, neglected opportunities, and special situations to achieve better returns. The key lesson is simple. Higher returns come from better decisions, not more decisions, and those decisions require effort and discipline. Chapter 16. Convertible Issues and Warrants. In this chapter, Benjamin Graham explains convertible securities and warrants and why investors should approach them with caution. His main point is simple. These investments may look attractive, but they are often more complex and riskier than they appear. Convertible securities are usually bonds or preferred stocks that can later be converted into common stock. At first, this sounds like a great deal because you get the stability of a bond along with the potential upside of a stock. But Graham warns that this combination can be misleading. Convertible securities are often priced in a way that favors the company issuing them, not the investor. For example, investors may accept lower interest from the bond in exchange for the option to convert into stock later. But if the stock does not perform well, the investor is left with a low-return bond, which is not a great outcome. This leads to an important idea. What looks like a win-win is often a compromise that reduces your margin of safety. Warrants, on the other hand, give investors the right to buy a stock at a fixed price within a certain time period. They are similar to options and are often seen as a way to profit from future price increases. However, Graham points out that warrants are highly speculative. Their value depends heavily on future price movements, timing, and market conditions, which makes them unpredictable. Graham emphasizes that both convertible securities and warrants are more complicated than regular stocks or bonds. They can encourage speculative thinking and often lack the level of safety that many investors need. For example, an investor might be attracted to the potential upside of a convertible bond without fully understanding the trade-offs involved. This is where mistakes happen. Imagine choosing between a simple, stable investment you fully understand and a more complex one with extra features but unclear risks. Many people are drawn to the second option because it sounds more exciting. But Graham's philosophy leans toward the first, because clarity and safety matter more than complexity and hype. The deeper message of this chapter is that complex investments often create the illusion of opportunity, but they can also increase risk. Graham consistently reminds investors, if you don't fully understand an investment, you shouldn't rely on it. To sum it up, in Chapter 16, Benjamin Graham teaches that convertible securities and warrants may seem attractive, but they often involve hidden risks and complexity. The key lesson is simple. Don't be distracted by complicated investment features. Focus on clarity, safety, and understanding. Chapter 17. 4 Extremely Instructive Case Histories. In this chapter, Benjamin Graham presents real-life examples of companies to show how investors can learn from both success and failure. His main point is simple. Real-world cases reveal the mistakes investors often make and how to avoid them. Graham walks through 4 different companies, each illustrating a different situation. Some companies appeared strong at first, but later declined, while others had hidden weaknesses that were not obvious to most investors. This chapter reinforces an important idea. What looks safe on the surface is not always safe in reality. For example, a company may show strong earnings or rapid growth, which attracts investors. But when you look deeper, you might find weak financial structure, excessive debt, or unstable performance. Over time, these weaknesses become more visible, and the company's value declines. Graham uses these examples to show that investors often rely too much on recent success, market reputation, or surface-level performance instead of doing deeper analysis. Another key lesson in this chapter is the danger of overconfidence. When a company performs well, investors may assume it will continue to do so. This leads to higher expectations and sometimes higher prices, which increases risk. But Graham reminds us, past success does not guarantee future stability. He also highlights how quickly situations can change. A company that seems strong today can face unexpected challenges tomorrow. This is why investors must always consider the long-term strength of a business, not just its current performance. For example, an investor who only looks at recent earnings may miss warning signs that the company's foundation is weakening. This chapter also emphasizes the importance of independent thinking. Many investors follow the crowd or rely on popular opinion when making decisions. But Graham shows that this can lead to poor outcomes, especially when the market is overly optimistic. The deeper message is that mistakes are often predictable if you look closely enough. By studying real examples, investors can train themselves to recognize warning signs and avoid repeating the same errors. To sum it up, in Chapter 17, Benjamin Graham teaches that real-life case studies reveal common investment mistakes, such as relying on surface-level performance, overconfidence, and ignoring underlying risks. The key lesson is simple. Learn from real examples, look beyond appearances, and always analyze the true strength of a company before investing. Chapter 18. A comparison of 8 pairs of companies. In this chapter, Benjamin Graham deepens the idea of comparison by analyzing pairs of companies side by side to highlight how small differences can lead to very different investment outcomes. His main point is simple. 2 companies may look similar, but a closer comparison reveals which one is truly the better investment. Graham shows that many investors make decisions based on surface-level information, such as popularity, recent performance, or general reputation. But when you compare companies directly, you begin to notice important differences in financial strength, earnings consistency, growth quality, and valuation. For example, 2 companies might both appear successful, but when you look deeper, one may have stable earnings, lower debt, and a reasonable price, while the other may have inconsistent performance, higher risk, and an overpriced stock. At first glance, they may seem equally attractive, but in reality, one is clearly the stronger investment. This leads to an important principle. The quality of a company must always be considered together with its price. Graham also emphasizes that investors should not be influenced by what is currently popular. Often, the more exciting company is the one that attracts attention and drives prices higher. But this can make it a worse investment if the price becomes too high relative to its value. On the other hand, a less popular company with solid fundamentals and a reasonable price may offer better long-term results. This reinforces a core idea in the book. The best investment is not always the most obvious one. Another key lesson is that comparison helps reduce mistakes. When you evaluate a company on its own, it is easy to overlook weaknesses, but when you compare it to another company, those weaknesses become clearer. For example, a company's earnings might seem strong until you compare them with a competitor that is performing more consistently with less risk. The deeper message of this chapter is that intelligent investing requires careful judgment, not quick decisions. To sum it up, in Chapter 18, Benjamin Graham teaches that comparing companies side by side helps investors identify true value and avoid being misled by surface-level performance. The key lesson is simple. Don't judge investments in isolation. Compare carefully and focus on both quality and price before making a decision. Chapter 19. Shareholders and Management, Dividend Policy. In this chapter, Benjamin Graham focuses on the relationship between shareholders and company management, especially when it comes to how profits are used. His main point is simple. As a shareholder, you own part of the company, so management should act in your best interest. When a company makes profits, it has 2 main options. Distribute the profits to shareholders as dividends, or retain the earnings and reinvest them into the business. At first, both options may seem equally good, but Graham makes it clear that what matters most is how effectively those profits are used. For example, if a company keeps its earnings and reinvests them into projects that increase growth and profitability, shareholders benefit in the long run. But if management keeps profits and uses them poorly on bad investments, unnecessary expansion, or inefficient decisions, then shareholders lose value. This leads to a key idea. Retaining earnings is only beneficial if it leads to real growth. Graham also points out that not all management teams act in the best interest of shareholders. Some may hold on to profits without clear purpose. avoid paying dividends even when they can afford to, or prioritize their own interests over those of investors. This creates a gap between ownership and control. Another important lesson in this chapter is the importance of a company's dividend record. A consistent and reasonable dividend history often reflects financial strength, stable earnings, and responsible management. For example, a company that has paid dividends steadily over many years shows that it is generating real profits and sharing them with its shareholders. On the other hand, if a company earns profits but neither pays dividends nor shows meaningful growth, it raises an important question: where is the money going? Graham encourages investors to pay attention to this. Even though individual investors may not directly control company decisions, they should still stay informed, evaluate management behavior, and understand how profits are being used. This reinforces a deeper message. When you invest, you are not just buying a stock, you are trusting people to manage your money. That trust should not be blind. To sum it up, in Chapter 19, Benjamin Graham teaches that how a company uses its profits is just as important as how much it earns. The key lesson is simple: pay attention to management decisions, because the way profits are handled determines whether your investment truly grows or not. Chapter 20. Margin of Safety. The central concept of investment. In this final chapter, Benjamin Graham introduces the most important principle in the entire book: the margin of safety. His main point is simple: always invest with a cushion that protects you from mistakes, uncertainty, and unexpected events. The margin of safety means buying an investment below its true value. This creates a buffer that reduces your risk if things do not go as planned. For example, if a stock is worth 100 but you buy it at 70, you have a margin of safety. Even if your estimate is slightly wrong or the market declines, you are still protected to some extent. This concept is powerful because investing is never perfect. You cannot predict the future with certainty. You may misjudge a company, overlook risks, or face unexpected market conditions. That is why Graham emphasizes the margin of safety is what protects you when you are wrong. Another key idea is that the margin of safety works best when combined with discipline and patience. Instead of chasing popular or expensive stocks, the intelligent investor waits for opportunities where price is clearly below value. This requires independent thinking, emotional control, and a long-term mindset. Graham also connects this idea to diversification. By combining a margin of safety with a diversified portfolio, investors further reduce risk. Even if one investment does not perform well, others can help balance the outcome. This reinforces an important principle. Successful investing is not about avoiding all losses. It is about managing risk intelligently. Graham makes it clear that there is no single formula or shortcut to guarantee success. But the margin of safety provides a reliable foundation for making sound decisions. The deeper message of this chapter is that protection comes before profit. Investors who focus only on returns often take unnecessary risks, but those who focus on safety build a stronger and more sustainable path to long-term success. To sum it up, in Chapter 20, Benjamin Graham teaches that the margin of safety is the foundation of intelligent investing. By buying below value and allowing room for error, investors protect themselves from uncertainty and reduce risk. The key lesson is simple: always leave room for error, because in investing, safety is what allows you to succeed in the long run. In conclusion, The Intelligent Investor by Benjamin Graham is not just a book about investing. It is a guide to thinking clearly, acting rationally, and making disciplined decisions in an unpredictable world. Throughout the book, Graham emphasizes that successful investing is not about chasing quick profits or following the crowd. Instead, it is about understanding the difference between investing and speculation, controlling your emotions, and focusing on long-term value. From learning how to build a balanced portfolio, to understanding market behavior through Mr. Market, to analyzing companies properly, and finally applying the principle of margin of safety, the message remains consistent. Intelligent investing is built on discipline, patience, and independent thinking. The real takeaway from this book is that the biggest risk is not the market itself, but how you respond to it. When you stay grounded, avoid emotional decisions, and focus on value rather than price, you give yourself the best chance of long-term success. If you found this breakdown helpful, make sure to like the video and subscribe to the channel for more book summaries on investing, mindset, and personal growth. If you want to go deeper and truly understand these concepts, I highly recommend reading the full book. Let me know in the comments, what was your biggest takeaway from this book? And if you enjoyed this video, check out my other summaries on the channel. This is the Lit Breakdown. I'll see you in the next one.